Hey everyone, today we're going to be looking at a quick overview on an earnings name that is coming up for tomorrow after market close. It's going to be March 15th, and that is Adobe, ticker symbol ADBE. Now, the concept that I want to quickly discuss today is the difference between risk premium harvesting and edge, right? Finding edge is really where you're in a market and you have some sort of information that's just higher than everyone else. You've found something that just, is lesser known from everyone else that yields, a higher expected value. Now, risk premium is just, something that's just baked into the price right there is compensation. Like the same reason why there's a premium that you pay to your insurance company, right? They have that compensation for the risk of, in this case, huge blowouts, right? Huge blowouts on earnings. That is what we're discussing today. And Adobe is definitely one of more the second ones because it is a larger company. So, does this mean that there's no opportunities here? No, not necessarily. Risk premium harvesting can also be great, especially around earnings. Taking a look at Adobe, we can see that historically this has been a great name to trade. It is more times than not profitable, which is always great. We have a cumulative P&L of 126%. That is always good. We can also see that despite volatility around COVID, there's really never been gigantic blowouts to either direction. There have been losses, but nothing like a Snapchat or a Peloton where it's 40, 50%. Now, the question that we have to ask is why have we seen this level of implied move rise recently? Why is this now starting to look more attractive than it did, say, a week ago? And that is mostly driven by what we're seeing in terms of retail sentiment and retail traders beginning to talk about this as it comes in earnings. But I think it's more or less so due to the broader market fear, right? And we discussed this earlier this week, the broader market fear of just everything that happened with Silicon Bank. Adobe, while as a well-established company, is kind of in that tech sector. They also had a recent acquisition announcement of Figma, which is another component that I think is very crucial in this. It could be a huge driver of the earnings. But in terms of historical performance, right? From a quantitative perspective, and from a qualitative perspective in their EPS performances, this has been pretty consistent, holding everything considered. Now, does that mean that this trade could produce a loss? Yes. But a blowout, right? Like a Snapchat level blowout is probably not likely on something like Adobe, right? Where you have a market cap north of 100 billion, where, the name has been well known for decades versus something that is a high yielding growth stock, lots of volatility in their earnings, lots of uncertainty surrounding their announcements. Analysts are constantly wrong. It's completely two different ball games. Put it simply, it just takes a lot more to make Adobe move. And being that's more established, it's not likely that they're going to get any information that the market doesn't know. And if the market isn't surprised, pretty unlikely that the stock's going to move a lot. So, just going over position structuring, it's going to be kind of the same thing with most trades surrounding around earnings. That's going to just be straddles, especially on something like Adobe, where if you have this inherent view that we shouldn't expect a huge blowout, right? Like a massive, just bankroll buster blowout, then it's probably not really crucial to buy protection here. Like there's probably no reason to buy wings like a Condor. If you can, obviously, Adobe does have a spot price of $333. If you do need a hedge, by all means. But ideally, it might be better to reconsider that strategy here and just sell straddles. Now, looking at this at the 332.5s, adjusting for after the close in terms of, volatility post the earnings, we can see that we should be expecting P&Ls around $400 to the downside and 270 to the upside. Now, obviously, you can hedge this with shares, as you're going to see here. This position would actually be short around 8 deltas. So by all means, if you want to do that, you can. The reason that I just wanted to use that for this example was just because if we look at the historical P&L, puts have, excuse me, been extremely much more of a better play. Like short delta has been a lot better than long delta recently. So if you want to look at continuation of that trend, just to hedge a little bit, that may be a course to go. But as always, guys, I highly recommend doing your own research. This is just an example to help you guys look, analyze, and see. So that's it for this one, guys. If you guys have any questions, feel free to message me. Also, if you guys have any names that you want us to check out, feel free to comment down below, and I'll see you guys in the next one. Peace.